the type of mindset that takes big risks and creates big income is the opposite of how we're going to protect it and grow it. Yeah, I need to learn how to be successful and make money, but what's the point if I don't know how to keep it and multiply it?
All I did is put my money to work. You start by changing where your money goes first.
When you position yourself properly, opportunities start to arise and be presented to you that otherwise you would never even know about.
What's up, everybody? It's another week of Wealth Webinar and WTF and Ask Me Anything. And tonight we've got Make Banking Great Again. You wonder why I can't figure out what webinar this is? That's all we're doing is teaching all of you how money works and how to think out of the box. That's what we're talking about. So let me preface today, because we got a really special guest. We got Justin from Kearns Capital on with us, and also the famous, the notorious Mr. Snaggy. So let's just do a quick intro. Justin, what's going on and where are you coming in from?
Man, I'm out here in Las Vegas, Nevada, enjoying my new spot, lower taxes, all that good stuff. But yeah, it's great to be here with the Be Your Own Bank. I don't even know what to call you guys. The experts, the best place for you to learn how to be your own bank.
Yeah, that's perfect. And Mr. Snaggy, I know you're coming in from East Coast down in lovely, is it hot yet? Florida? Got any snakes?
It is. We got some crazy thunderstorms coming through. Last night it was just rumbling in the house, kept me awake in the middle of the night. It was just hovering right over the ocean, right outside my back door, and just rumbling all night. So summer's coming. It's looking to be an active hurricane season, which is just going to destroy the home insurance costs even more, which are already skyrocketing down here. But we might have the future president of the United States as our governor still. So I have faith in him to do something good for us. So we'll see what happens.
That's fantastic. So
that was a joke, by the way. I put no faith in politicians. You got to control your own wealth and your own destiny, period. Go ahead.
I love it. You know, that's always our model. Like, we help people take back control of their money by teaching them how to be the bank. But a lot of people, when I say how to be the bank, your mind immediately goes one of a couple places. If you've been around this campfire for a while, you start thinking about the bank being a whole life insurance policy. But let me take you one step further. It's not a whole life insurance policy. It is a specially designed and engineered whole life insurance policy. And I know that's what everybody always wants us to talk about, but you know what? Hang on a second. We're going to be talking about that all night tonight. So for some of you, you're going to be joining us tonight at 6 p.m. for Make Banking Great Again webinar. And we're doing a series of these webinars. That's going to be tonight. There's, I think, 1,500 people registered. So it's going to be an action-packed evening. And that's all we're going to be talking about is privatized banking and the infinite banking concept. So today, I thought we would talk about something different. I thought we'd talk about thinking out of the box, thinking about different asset classes, thinking about other places you can put your money to have your money work for you. And you know, what money is that? Some of you, all of you, come from different stages in your wealth journey. And different stages could be, you might be in the hustle stage. We've all been there. It's where you're hustling, you're really working hard, you're taking the overtime, you're putting in the hours, trying to build up the bank. Hopefully it's not putting in the overtime just to make ends meet. And if that's the case, that's okay too, because we've got some ways where you can fix that problem. But all of you have money somewhere. It might be in a 401k. Maybe it's an old 401k. Maybe you got money in IRAs, Roth IRAs. Maybe you just got lazy money sitting under the mattress. Because, I mean, hey, listen, when you look around out there, it does feel a lot like 1929. And we all know during the Great Depression, what was the #1 savings account for most Americans? That's right, your mattress and your walls and your floorboards. You've heard the stories. People were storing cash and money under their mattress because why? They didn't trust the banks. Why was it that they used money and hid it in the walls? They didn't trust the banks. Is that really too much different than today? How many of you legitimately and wholeheartedly feel super warm and fuzzy about keeping a whole lot of money in traditional banks? Any of you? Do we have anybody that just loves traditional banks right now? And if you do, I know why. They give you free suckers, and not just suckers, but they give you dumb suckers. So, you know, some people love banks because of those good old dumb suckers and that warm, nice, burnt black coffee that they serve. Any of you ever had coffee at your local bank? It's awful. I mean, they must leave it out like 3-4 days. So what I want to talk about is helping you reposition some assets helping you look at the outside the box investments that you can put money into that really a lot of you might think have only been available for the wealthy. But there's one asset class that all of you probably do put money in, probably have put money in, or at least want to, and that is real estate. How many real estate investors do we have on here? Put I in the chat right now. So we got a bunch. Perfect. So let's start with that asset class, shall we? And I'm going to make this an open discussion because we've got all three of us. I'm not going to be the only one talking here, but on WTF this morning, What the F, we talked about real estate. And I think it's a really good place because real estate right now is either going to be not such a good place for you to have your money, or it could in the future be one of the greatest opportunities for all of you for future money. So I want to talk a little bit about the environment and sort of recap what we went over a little bit in WTF because it's super important. We're at a really weird point in time in real estate. So I don't care what kind of real estate we're talking about. We could just talk about single family homes that you're going to flip. Okay. Then we can talk about, let's just kind of talk about doubles. We'll just draw a line right down the middle here. So we'll talk about, small multifamilies. Let's then talk about the big old multifamilies, the ones that got lots and lots of apartments in them. So I don't know, forget about my drawing, but I guess that's good enough. And then let's talk about some of those big commercial buildings where the bottom might be retail. So we'll just call this retail. This is the mixed use model. And these are apartments up top. Okay. So we'll just hit on some of those. So it doesn't matter what one of these types of real estate you're in. Every one of these requires money. So you cannot buy any of these, not a single family, not a multifamily, not a mixed use, and not a big old multifamily without money. So where does the money come from in most cases? Well, some of you would say banks. Some of you, if you're really smart, would say, oh, this thing called PMC, Private Money Club. Smart. Some of you would say hard money lenders. And some of you would just say, I don't know, I'll figure it out. There's always a plan, I guess. The things I do want to hit on are these two right here, banks and hard money lenders. With what's happening right now in all the bank failures, with the interest rates doing what they are, I mean, we're over 7% again. And all of this, I will tell you right now that if you're relying on banks, you're soon going to be very disappointed. Because I know for a fact, every bank in this country is tightening the reins. They're not lending like they were. They don't want to lend. They're being very, very particular on who they're lending with. And if you weren't paying attention in the news not long ago, if you got a super good credit score, you're now going to actually pay more to buy a primary home. So it doesn't matter what you're doing, but banks are going to definitely be more difficult. We're seeing it with some of the houses that we're selling. We're trying to sell houses. We're getting offers on the houses, and the offers are falling apart, not because the people change their mind, but because the bank changes their mind, because the bank finds the stupidest reasons. I'll give you an example. One of the houses we're selling, we were going to sell it to one of Larissa's family members, which we're still trying, and they were doing a first-time home buyer loan. Now, they had to move out of their apartment because it was condemned by the building inspector, so we let them move into the house before they closed. Because they moved into the house, that disqualified them from buying this house on a first-time home buyer. Who knew? But I'm just saying, there's all sorts of things that are happening in the regular banking world that are restricting people from getting money to buy the things they want. So what they do is they move over to this hard money lending space. And if you really look at the hard money institutional lenders, you know what they are? Some of them are hedge funds. It's Wall Street money. It's institutional money, which basically, when you really start talking about institutional Wall Street money, it is very similar to bank money. When banks dry up and the Fed tightens, so do hedge funds, so do institutions. They don't want to lend as much. Don't believe me? 2009, 10, 11, try getting a loan back then with a hard money lender. It was very difficult. Even during the pandemic, hard money lenders tightened up. This is going to happen again. So really your options are Private Money Club, and those of you that are just saying, I don't know, I'll figure it out. So real estate, although it is a great opportunity if you buy it right, there are some very risky things that you need to do. So earlier we were talking about different concerns we have, and I'd like to just have both of you kind of feed in, like, what are your thoughts on single family flips, or what is commonly known as the BRRRR model? Buy, rent, rehab, refinance, repeat. What are your thoughts on this model right now with what's going on?
I think it's extremely difficult. I know a lot of people in that space, whether you're even just wholesaling the house or doing the flip, man, values are coming down. There's a a mismatch between the expectation of what a buyer wants to pay based off what the debt costs now. So you're getting squeezed. It's almost impossible to get a transaction done because there's such a mismatch in what you need to sell that house for and what someone's willing to pay for it now.
Perfect. Stephen, what are your thoughts here? Single family, burrs, or flips?
I still love it. The experienced operators and those that understand actual entrepreneurship and investing that are excelling. I think that there's a lot more risk right now, especially for those that don't understand the market and what's happening and how to allow for that and the place where they're investing. But it's very regional right now. It's very, depends on where the properties are located and who the operator is. But I think there's a lot of opportunity, and I think there's going to be a lot more opportunity coming in the near to mid future as well. But again, it boils down to education and knowing what you're doing the right way.
Well said. So let's go one down. We'll talk about like small multifamily apartment complexes. What are your thoughts on them? Justin, we'll start with you.
I think it's better than buying a single door. Scale is always better. At least if you're at the commercial level, which is more than 4 units. Now it's more operating as a business versus the comps next door, right? So you have a lot more influence on how you can change the value of that property once it's considered commercial. So I know we're going to get to the bigger ones soon, but the bigger scale you can get to, even if you're going to be a small piece of the project, that's my preference.
Yeah, with the smaller 4+, 4 to let's say 25 unit stuff. It's not a bad place to be right now but it goes back to the deals. A lot of the big hedge funds and big BlackRocks and companies came in over the last several years and have bought up a lot of that and really driven cap rates down and really made it a very competitive market for individual investors. But again, if you can find those deals, it's a good place to be because housing has become so expensive. People are being forced into multifamily, duplexes, quadplexes, things that they can afford. So it's allowed for that market to stay strong. And as we see the market turn and presumably foreclosures starting to come back on, possibly like we saw in the 2008 crash, that's what happened back then is everybody went over to the multifamily space and because you have to have a place to live. You can't afford a house. You lose your house to foreclosure. Where do you go? You're forced to rent. You can't afford rents in a single family home or qualify even to rent. You got to go into that type of property. So again, in the right situation, I think it's good. But again, it's very competitive right now and a little bit more risky at this time.
And before we move to multifamily and mixed use, one thing I want to hit over here, just because it's gotten a lot of popularity. We know the folks, that kind of do this, but this thing called sub 2. This is kind of for these people down here that say they'll figure it out. They go in and they negotiate the purchase of a property, but they negotiate it by having the owner of the property hold the note and basically hold it's sub 2. You're buying the property sub to the mortgage, essentially is what it is. Now, I think this model is great for people that are trying to get into real estate that don't have a lot of capital that just, want to go out and they want to negotiate the deals. Because what's nice about it is right now you've got a couple dynamics that I think are important to mention. Over the last several years, actually probably the last 15, well, maybe not 15, 12 to 13 years, this is what the price of real estate has done. And it's actually really, if I want to be particular, and since COVID, it kind of went like this. So you're at a very high point right now. You're off the highs maybe a little bit, but you're here. So you're still at a really high price point. And I know we're coming off the highs in certain parts of the country, but still, it's still very high in like the grand scheme of things. And a lot of people are saying that this is supported by demand. But I'm going to say that this is justified. The downturn is justified not by demand, but by cost. It's going to be cost prohibitive. No matter what the demand is, the demand has limits when it comes to the different, things like interest rates and cost and, just making numbers work. It's really just mathematics. There's only so much you can charge in rent for some of these. And if you're paying 7% for a mortgage, or if it's hard money, you're paying 12, 13, 14, 15%. Like at what point does it just not start to pencil? Well, it'll always pencil if you think that the real estate's going to keep going up in value. That's what's happened in the past. We've been able to make a lot of things pencil because we've had the rent plus the appreciation. But at this point, we're on the way back down.
And I'll show you the chart I showed this morning, Chris,
Yeah,
just kind of to your point there. So the blue line is the cost of rent since the 70s. The yellow line is the cost to buy, average mortgage payment since the 70s. So you can see where we're at over the last 2-3 years, where the cost to buy is just skyrocketed. we've seen the cost of rents go up in a lot of areas, but not nearly as close as we've seen the price of real estate go up. And you can see every time in the past, the prices of real estate has gone way above the price of rents. Those home prices have all dropped shortly after to bring it back in line with that steady rent increase. And so if we extrapolate that out into what's coming up in the future, we can assume that the prices are going to start coming down to purchase homes, which is going to lead you right into what you're drawing behind you, Chris.
Perfect. So that's way cleaner and better looking than what I'm trying to draw. But you can all see, if you look at this chart here, where do you think pricing has to go? The rent line seems pretty sustainable. I mean, a little bit of a blip there from 2022. Maybe that'll settle back down, from 18 to 1600 or somewhere in that range. But that cost to buy, that's just not a sustainable model. I mean, anytime you see something rocket up, and literally like my drawing was pretty accurate where I rechanged it, made it a straight line up. I mean, that's not a sustainable model. So if you just use logic and you really just look at what's going on out there, people are losing their jobs. There's going to be more unemployed people out there soon as jobs go away and as companies continue these layoffs. Not only that, as the economy softens, people are just going to have less and less money. Raises are going to slow down. Bonuses will slow down. We all know the routine. It's not our first rodeo, or at least not all of our first rodeo. Recessions are not good. And when all that happens, it's going to force price down. So let me come back over here and talk about the current place where we're at. So I think we already hit the flips and we hit the multi, the 4+ units, 4 to 25. Both can be a good opportunity. I think here with the flips, kind of, I'll be right in the middle of what Stephen and Justin said. I think this can be a good opportunity, but you got to be really freaking good at what you do. You better have really good coaching. You better be very knowledgeable. You better have a network or a community of people to go to get money. You better have contractors online that you trust. Good luck. If all those things line up, great. If it's the BRRRR model, I'd be very careful, because if I'm financing a deal, if I'm lending money on Private Money Club and somebody's doing a BRRRR, I know the missing link here, the missing piece is going to be that refinance piece. Because if they got to refinance it, but yet banks are tightening, the chance of them actually being able to refinance at the current rates and showing that it pencil with a bank, they're definitely not what they were a few years ago. So now all of a sudden the backup plan is, okay, I'll sell the property. But if the price of the property comes down, or the cost for buying the house and renovating the house went up, because not only are houses and real estate expensive, renovation costs are through the roof. We just renovated a house. It wasn't ours, but it was somebody we know that Larissa GC'd and designed the house. I mean, the renovation budget was 240 grand. It's absurd. And I look at it, I mean, it's beautiful. And she had to do everything, but still, I'm like, how is this 240 grand? I joke around with her and I'm like, sweetie, like 5 years ago, we could have done this for 70 grand. And there's a lot of truth with that. Maybe not 70, but at least 100. Price of everything's gone up. So this is definitely risky. And if you're going to flip, you better be nimble. And I would say less is more. So because the markets are still high and there are people, if you're focused on flipping, please, please, please focus on the lower price point houses, the houses that would go to like first-time home buyers, where most of the demand is. If you're flipping houses like Vanilla Ice style, that are those really expensive ones, like houses like what Justin's in here, you're gonna take a bath. Justin gets to rent that beautiful house, and I don't know if that's because the guy couldn't sell it that owned it, or maybe they wanted to rent it, but that's going to probably be the case a lot. So this one's risky. But the other thing too that you also have to factor in with both of these models is, as the price comes down with these, you're going to start running out of options. And then let me come over to this one, because I didn't hit it much. Sub 2, very popular. Seems easy. You walk in, a lot of these deals, that you can get into sub 2. You have no money out of pocket because you just negotiate the terms and you pay the people whatever they want. So now let's hit the problem I see. Sub 2 is a long-term thing. For the people really good at it, probably be okay. But for the people just getting into it, rushing in, thinking this is the best thing since sliced bread, hold on a second. I don't mean to poo-poo on anyone's parade here, but if you're negotiating with a seller of a property, and you're saying, hey, I'll pay you whatever you want for the house. I'll pay you your price, which, just so you know, if you pay their price, you're paying top of the market. Top. There's a reason they're doing this sub 2 deal with you. And it's probably because they couldn't sell the house on the open market at that full price. So you're giving them full price. And then they're holding the mortgage. So you're controlling the terms. The seller controls the price. So already you're upside down or pretty close to it if you buy it. Most of them will turn around and rent. So now if they're renting, that's great. And you need to get out of it. Let's just say a tenant moves out, single family house. You do a sub 2, you're renting it out, somebody moves out. Now you've got a month, sometimes 2 months. Let's say they trash it and it's gonna be 3 months. Can you carry that property for 3 months? Let's just say something tragic happens. You just can't re-rent it. Something drastically went wrong. And now you got to carry it. What are you going to do? Chances are you're just going to bail out. You're going to bail out on the borrower because you really got no skin in the game and the borrower is left holding the bag. So that's the only thing I look at and I worry about. And a lot of times if you're doing sub 2 and you're putting some money in, just realize if you're doing a sub 2, you are buying at the highest price. If the price of your real estate goes down, what's your exit plan? How are you going to get out of it? I mean, listen, like it's kind of like anything. Like, I don't care if it's marriage or whatever else. When you get into something, know how you're going to get out of it. Like, I think a lot of people are getting into these kind of deals with no exit plan on how to get out. Same thing down here with multifamilies. They're getting into them. They're paying top price right now for 4 to 25, definitely paying top price. So that's a hot thing. Yes, there's a lot of demand for apartments. But what if, like that chart showed, we do come down in rent? So now a couple $100 less per month is being brought in and you have a problem. I don't know, you get a tax bill from the IRS, something happens in your family, somebody gets sick and you need money and you need to exit this property, you need to sell it. You're not going to be able to sell it for what you paid for it in most cases. I mean, maybe you got lucky and you bought it right. Now, this is where, like what Steven said, with both of these models, like if you're buying these properties, just understand the problem isn't so much the buy or the renting or the Airbnb. The problem is, how are you going to exit the property and at what price? Can you hold these properties for 10 years? I think that's the real question you got to ask. And are you okay with that? If the answer is yes, giddy up and go. Now, Justin, I know your strong spot is the multifamily. So I'm just going to let you take over and run with, and if we could, just let's talk multifamily and let's talk apartments and mixed use, just kind of as one. What are your thoughts in this space?
Yeah, I was out at the Multifamily Wealth Conference about a month ago, some of the brightest minds in the space. And they said that multifamily apartment complexes, the bigger ones, you know, over 100 units, they're trading already at a 20% discount with the recent run up in rates. The big consensus there was that there's 20% more to go. Most of these loans, like we were talking about this morning, are on shorter durations. So you're going to have distressed operators that won't be able to service their debt. But as an LP investor, for me, it's not primarily what I do, but this is my favorite place to park money as an LP. And what I'm seeing as an investor is there is pain already in the space, right? Cash flows are getting compressed. There are vacancy issues. Delinquencies are going up right alongside with the credit card debt hitting an all-time high. So there's going to be pain, but at least when I'm diversified 200, 300 units, we can work through some of that individual pain, which is what terrifies me about single doors. You know, when you have all your eggs in one basket. So to Steven's point, it's always a good time to buy it if you can buy it right. The big consensus moving forward for multifamily was that creative financing is going to be the most important thing. So if you can grab a big apartment complex right now at a 20% discount, but assume the loan 3-4%, whatever that operator has, you know, I think that's a pretty good deal, and you could still buy some multifamily right now.
I like that. Steven, you've got a lot of experience in this space too. And I know our coaches, Mike and Mike, do a lot of this stuff from ground up to that. But what is your thought in the multifamily space and the mixed use?
No, I like it. I mean, the commercial, you know, mixed use, you know, it worries me a little bit just with everything that we've seen, you know, some of the office buildings we were talking about earlier, some of the retail space, you know, I question where that's going to go. You know, especially if the economy starts to take a hit. And, you know, we keep hearing all these stories that these companies went away from in-person working and they tried to go back to it and it's not really working and they're kind of letting people stay home. And I mean, I personally know a lot of people that are switching over to work at home jobs right now. And I think that's probably the foreseeable future, you know, whether that turns down the road. So I think some of that space is in some trouble. But again, multifamily apartment complexes, I think what happened is a lot of these hedge funds, you know, BlackRocks, we saw it with residential real estate. They went in and they bought up neighborhoods. They bought up tons of, you know, residential single family homes. And a lot of that didn't work out for them. While they're getting out of those, a lot of those, like the Zillows, home buying divisions, they've all closed down now. And I think they realized that single family property is not as easy as people think it is. It's not just going in, buying the properties, they're making a lot of money. There's a lot more to it, which, why I'm such a, backer of individual landlords that own, 1 to 10 rental properties, because it's a lot of work and they provide a great service. And I don't love the institutionalization of, that space. And I think they've done a lot of that with the multifamily space too. They've gone and bought these apartment complexes and they realize they're tougher to manage than what they thought. There's a lot more to it. And I know some very good operators in that space, and they're very good at what they do. And they've been driven out of it because of these big players that came in and drove prices up and cap rates down and everything. But I think we're starting to see that turn a little bit. And I think as the banks tighten up their lending and money starts to get restricted, especially some of these bigger institutions and corporations, I think we'll go back to seeing individuals, people like you and me and Justin that can go in with operators and do these the right way again. So I think we saw kind of that pendulum swing for the last 3, 4, 5, 6, 7 years. And I think we're starting to see it swing back. So again, for us, people watching right now, that just means opportunity. Learn right now what to do, learn how to get into that, how to start finding these, how to do the math, make the connections, build your network, get your money ready to go, get investors ready to go that have money and people that are interested in that kind of thing. So then when those opportunities do arise, we're ready to pounce, take action, and make things happen for ourselves.
Love it.
Yeah. One more thing I just want to say about the multifamily space. A lot of us are not going to be GPs or general partners and put these big deals together, but you can ride these deals as an LP and a limited partner, right? So the biggest thing is I'm actually not in it for the returns. It's a really important point. It's mostly tax mitigation for me. When you get into these big projects, they're value adds or development deals, even if they weren't cash flowing, if they weren't appreciating, it's helping me mitigate taxes elsewhere in my portfolio. So it's just something to consider when you do start making investments that are passive, looking for ways to get passive losses on paper so that you can reduce your taxable exposure and actually get a better real return. Because if you get a monster return, you have to give half of it to the government. I mean, you didn't really get that return.
I love that perspective. We very rarely talk about that, but did everybody hear that? So, Justin's looking at he's looking at the syndication model, and he's doing it primarily for the tax reasons. And if you didn't already know that, when you're an LP in it, you're actually a partner in the project, which means you share in the depreciation and all the different things that can benefit you from taxes. And that's a massive play right there. But you notice how he said he's not in it for the return. And a lot of you probably are like, well, that's crazy. Why? Oh, because the return he's getting is probably far greater because he doesn't pay the government as much in taxes legally because he's participating in the depreciation and all the tax advantages. So really, when you think of the return, it's just a different way to look at it. It's the same thing if you don't pay the government 40% in taxes. If you only pay them 20, isn't that kind of like making 20%? You see, it's just the way you look at things. And every one of you are at a different stage, a different point, and a different, part of your wealth journey. Justin happens to be at the point where tax, planning in that kind of return, I don't want to call it a return, but that reason for buying real estate made sense to him. For all of you, it's different. So the reason I wanted to point all these out is I think the resounding thing you see is right now, there's a little bit of risk. There's a little bit of risk in each one of these different models, but there's a lot of opportunity coming in this. So a lot of times when it comes to real estate, I mean, I can only speak for how I do it. And all of you know, I've been selling my rental portfolio off. I've got another one hitting the market in June. I've got 3 under contract. I'm trying to get rid of all of them. And people think I'm crazy. I'm not crazy. This is the high point. I kind of off the high a little bit now, but I'm still just trying to flush the system. I had 91 of these things, and I'm down to, if I'm not mistaken, under 10 now. But you see, as I've sold them, I've gotten the money, and yes, I've paid the taxes. It's not been fun. The taxes now, my planning is the complex trust structure. Not going to get into that today, but you guys can all learn about that at the 3-day event that we have going on next weekend. So we'll put that link up so you can all take advantage of the 3-day. We got a really awesome offer because, in this wealth webinar, we're going to cover some really neat things, but we're not going to hit all these things real deep. Justin's going to be with us at the 3-day training next weekend. It's our keystone event that we do. It is a 3-day virtual training. It's next Friday, Saturday, and Sunday. And it's packed, literally. We're going to be diving deep into opportunities that you're all going to be taking advantage of and how you can take advantage of. And we got 3 days to get all this out. We're going to cover everything from tax planning. Some of you that maybe are thinking, oh, you know what, I really need to find out how to pay less in taxes. Well, we've got a speaker coming on that's going to show you how to do the 1040 tax structure. Okay, so we've got that. We've got other speakers coming in that will show you kind of what Justin was talking about. How can you use entities and syndications and different stuff to mitigate some of that tax and that liability? So for all of you that didn't join us last night, that are interested in joining us next weekend, we've got a really cool offer today. So we're going to be putting the link up. The cost for the 3-day event is normally $297, but everybody that's on here is going to be able to come for $197. Plus, we're going to give you the trainings from the last 3-day, which are really important because we're not going to do the same stuff we did on the last 3-day. We're going to be doing all new material, but it sure would be nice for you to have the edited and time-stamped recordings of the last one. So we're going to give that to you. So it's $197. You get this 3-day coming up, the recordings of this 3-day edited, time-stamped, so you can find what you need quick, plus the last one. And Stephen, did you get anything done for the limited edition thing that we're going to be giving away?
We're working on it. Actually, Ted called me right as we were starting here, so I got to call him back, but he's got some ideas and we're working on it. So yeah.
We're going to do something super fun, and I'm going to get this out, and then we're going to carry on, folks. I don't want to use this whole wealth webinar.
And I got one opportunity I just wanted to kind of tease with after you're done, Chris. Go ahead.
Okay. So we got this idea last night. We gave away limited edition skateboards, right? BYOB skate decks. There's only 100 of them. And we basically, last night, they're gone. There's no more of these. So I was thinking, what else can we give you folks that would be so unique that the only way you could ever get it would be to come to the 3-day event? So we came up with that. And Stephen, are we doing for this one the hat, or are we doing the hoodie?
We're working. It's gonna be hat or hoodie, or we're gonna do something.
So
really
you're gonna
cool.
get the pick. So we don't have it done, and I apologize. We just ran out of time because we came up with this idea at like 10 last night. But any of you from this wealth webinar only, you're going to have an opportunity to get it $100 off for the 3-day training. See me, Justin, Stephen, and a whole bunch of other amazing speakers, which we'll show at the end of today's training. But also you're going to get your choice of either a limited edition. And when I say limited edition, there's 128 of you on here. There's only going to be the opportunity for 128 of you to have this particular hat or hoodie. It will be a one print wonder, if you will. No one else ever will have the same shirt as you. And here's going to be the title of it. It's going to be Make Banking Great Again. This will be the only way you can have that is by attending the 3-day. So we're going to get into that in a little bit. I just wanted to preface that. So let's do this real quick. All of you that are on here, many of you are in real estate. So you just heard us talk about real estate, because I want to kick it into the high gear after this and talk about the next investment opportunity. But what are your thoughts on everything we said? Does anyone have anything you want to say about that? If you could put it in the Q&A. I just want to hit a few things, because I saw some people like Mark Perry said, where do you see new build single family rent market going? So Mark, I believe you're talking about like people that are building brand new builds and then renting them out, correct? I would guess that's what you're talking about. I'll just start with this. I would put that up here, except for it's a new build, so the costs are going to be higher, and that means the rent's going to be higher. I don't think it's a terrible place, depending on where in the country it's at, because there's a lot of places where price of real estate is just out of whack. You can't do it. So families are looking for new builds. They're looking for nice living spaces, and they're looking to rent those spaces, and they'll pay more because they can't afford a house, or they're just not having any luck getting financing for a house. So renting what they want is a nice alternative. I don't think it's a terrible thing, but again, you just got to be really careful on the exit. So those builders that are building these, chances are they're the BlackRocks and the Blackstones. They can just hold those things for a long time. They can ride the entire cycle out. But if you were doing that, you were building them, I'd say buyer beware, because that's going to be a risky thing, because you're definitely going to build it. It's going to cost you more than what you're probably going to be able to sell it for. And your chance of losing money in the next couple of years, 5, maybe even 7 years, is pretty high.
Yeah, but if we look at some of these experienced operators like ROI Property Group and what they're doing, building entire rental communities, neighborhoods, and they've done so by partnering with builders and being able to control costs and be able to build these at good prices. They were able to get the land at good prices. When we look at the charts of what home ownership costs and we look at what rents are today, And then we look at what's going on with people's savings dropping, people's credit usage going up. It's destroying their credit scores. They have no savings for down payments. They can't afford homes because they've appreciated so high. They're going to have to rent. So to me, people doing things like that, like the Fullers are doing, building those communities, makes a lot of sense in this market right now, just because of the unaffordability of housing. And even with a market correction, we all know with a market correction comes probably a recession, a down economy, loss of jobs, which just amplifies the problem of home ownership. Just because you're buying something cheaper doesn't mean somebody can then afford it, because then their finances have gone all down also, again, forcing them to rent, because you have to live somewhere. That's the bottom line. It's one of the things I've always loved about real estate. Up market, down market, level market, it doesn't matter. There's always a strategy to follow if you know what you're doing.
Love that. No, it's great. Listen, there's a lot of different things we can look at with these, and everybody's going to have a different opinion. It's just, you really got to look at the operator. And I constantly say, like, these are the times right now when a good coach, a good mentor, somebody that's been through market cycles like this, you almost can't pay enough for them. I mean, because they're going to keep you on the straight and narrow. Now, I would be careful about going with the guy that's flipped 5 houses during the bull market, has never lost money, drives a Lamborghini and all that good stuff, and says, I'm the best there is. You've never even seen a down cycle. You've never even seen a recession. Did you go through 2008? Did you almost lose your butt after that fell out? Because that's where you learn when you fail. You don't learn just by winning all the time. You learn when you get smacked, punched in the nose, and then you're down on your knees wondering, well, boy, that sucked. What did I do wrong there? Would you agree with that, Justin?
Absolutely. Failure is the greatest teacher there is, but that's why we study people who have been through those failures as well, to try and mitigate some of that along the process. So a combination of both, I think, is the recipe for success. But if you think you're getting out of this game without getting hurt, just don't even get in.
Very smart. Wise words.
And Chris, I just wanted to share one, just kind of like bringing this all together. We've been talking about how it's important to be educated, have the right connections, be prepared with money and everything. Well, why you want to do stuff like that is because all of a sudden, when you position yourself properly, opportunities start to arise and be presented to you that otherwise you would never even know about. And you see that in your own personal real estate business, where you've told me, I can't count how many times over the last 3 years, you're never buying real estate again in New York. You're never flipping another house. And every time I talk to you a week later, hey, we just started a new project. Why? Because people bring you deals that are too good to say no to. They're no brainers, even though you don't even want in the business. And we just saw kind of experience that a little bit recently, where Chris and I are partners in a private real estate fund known as Inicio Capital Group. And our partners just brought a deal to the table that we invested in, but otherwise would have never been found because banks couldn't fund it at the time. But this is a beautiful community. I just want to share it. So this is something we just invested in with our private fund. It's the Four Seasons private residences out where Justin is in Las Vegas.
That is literally going to be in my view.
Yeah, overlooking.
I'm not happy about it.
The Vegas Strip. So these big, beautiful private residences, very specialty market, but there's a lot of demand for this kind of thing, especially out in that area right now. So we were able to invest in this, incredible profits, incredible deal by doing that. But the only reason was because of who's in that private fund and the connections over the last 20 to 30 years that they've made for something like this to come to that network. So I just want to kind of point out in real life how this works, because this is something literally that a lot of you have invested in Inicio Capital Group, and then we invested the funds into this project, just as an example of how that works.
Keep that up real quick, because I just want to point out the only people that don't like this, if you look at that big building in the back, directly behind that, see that little hill? That's Justin's house. So you can see why he doesn't.
It's literally
like
the same
project.
community.
Yep. So you're looking up the hill. You're looking right into Justin's whatever front windows there.
That's a beautiful view, though, huh?
Sure is.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
But I mean, there's a lot to be said about that. I mean, the future of real estate and future of home ownership might very well be a lot more of that, because the workforce housing, I believe, is what they're calling it. That's going to become ever more popular as people now are working more from home. So they want more amenities at their house because they're not going to an office anymore. And businesses are able to trim their fat because they can get rid of these expensive buildings, these expensive leases, and they can then just do more workforce out in their homes and basically support them that way. Maybe even if they give them a raise so that then they can live in a community where it's like that one you saw, where now you've got more of the amenities for work-life balance and working from home. That's, I see, definitely something that we haven't seen in the past that is going to be ever more popular right now. More people renting, but renting because they want the freedom and they want the amenities that come along with that type of a community. I really think that's going to be pretty exciting to see that happen, and to be able to get into deals like that is definitely an opportunity. So right there, I mean, if any of you are interested in that, we can set up a call to talk about Inicio and what we're doing there. We don't have much longer. I think we only have like another 3 months at best until we're closing that fund down. But that's not the only big opportunity that it's only got a little bit longer, because there's another one that I found, and this is why I wanted to have Justin on. This is where I wanted to go next. I've known about this for a long time, but I've never really deeply invested into hedge funds. I used to, back when I was in Wall Street, I used to privately trade the forex. And if you don't know what the forex is, it's currency exchange. That's all it is. And what I would do is I learned by going to this training that I spent $12,000 on. I learned how at 3 o'clock in the morning, I could get up every single, I think I did it 3 times a week, and I could trade a convergence point that almost always happened at this time. And I don't know if it still does, but it was between like 3 and 4 in the morning, the euro and the US dollar converged. And I would make a trade and then I would close the trade. Now, I made great money doing that, but as you can all think, like that's not sustainable because I didn't want to get up. So eventually I just stopped doing it, but I never lost money doing it. Every trade I made, almost every trade I made money. Wasn't a lot, but consistent and persistent returns. The problem with that was I didn't have the time or the oomph to want to get up every single day or even every other day to make that trade. But that was then. That was 2009 I was doing that, when I was deep into my Wall Street years trying to find alternative ways to make money, because obviously that was right after the Great Recession. Now, today, they don't do that. Justin doesn't get up at 3 in the morning, go to his terminal and his computer and make that trade. Computers do it all today. AI does it all today. Algorithms do it all, but they do a way better job than me, because I talked about one convergence, but there's probably hundreds of convergence points between various currencies. I only did the US and the euro, but imagine the US versus the yuan or any currency that there is. There's got to be just so many of them where they just fluctuate, and each fluctuation where one flips and goes higher than the other creates a massive opportunity. An opportunity that none of the 124 people on here could ever take advantage of on a consistent basis, but an algorithm can. So when I started learning about this hedge fund through Justin, what I really liked about it wasn't just that it was in forex, and I knew forex was a pretty stable market and a really good opportunity right now, but it was also the liquidity of the fund, because I don't like putting my money out when I can't get it back for long periods of time. So the liquidity was 12 months. I put it in. At 12 months, if I want my money, I can take my money out, right? You guys watch maybe my YouTube video where it's, I want my money and I want it now. That, I don't even remember what that's from, but that's one other thing I liked about it. And the other thing I absolutely loved about this was nothing to do with the private hedge fund, but it was the motivation and the reason that Justin found this private hedge fund. Because it wasn't what you thought. It wasn't because he's like, oh, I found this thing and I'm going to become a millionaire by doing this private hedge fund. It was because of a personal event that happened within his family that put him on the hunt, or on the journey of finding the investments for his own money. No different than me, no different than any of you. You are all on a journey to find where your money should land, where it's going to do what you want. So Justin, I'm going to pin you up here, and I would love to just have you tell that story, because that was the number one thing, just so you know, that got me to really think about this and say, wow. Like, I want to do what the wealthy do. And the fact that you put more time in than I did looking at this thing, that's how I got started here. And I don't even have a big investment. I'm only 100 in, but believe me, I'll be going deeper and yeah, take it from there.
Yeah, it's very interesting how the way you grow up, the things that happen to you influence the way you approach life. And everybody on this call, I guarantee you, knows somebody who's an entrepreneur that was excellent at it, made a bunch of money, and then lost it all. It's a very, very common story. And that's because the skill set of creating income and building a business has absolutely nothing to do with turning that income into wealth. It's completely different things. And the type of mindset that takes big risks and creates big income is the opposite of how we're going to protect it and grow it. So that's what basically happened when I was growing up. You know, I grew up the first 12 years of my life incredibly privileged. My father's this incredible entrepreneur. He built several businesses, sold them, millions and millions of dollars, puts it all in one place, cardinal sin, loses it all in a Ponzi scheme. You know, I go from having an ice rink in my backyard, skate park in the basement, to an apartment within a year. And when you have that type of financial reversal, it will tear your family apart. My parents fought, they were divorced within a year. It was ugly in the courts, and all because of money. Protection of money is first. And that was my mindset was, yeah, I need to learn how to be successful and make money, but what's the point if I don't know how to keep it and multiply it? So all of my studying and obsession in my early 20s was about what to do when I got it, because I didn't have any money. And my dad was starting another company from zero when I was in my late teens. And I joined him on that mission, and we grew it together for the past 15 years. And then we had a wonderful thing in a weird way called a pandemic that put everybody in the market for home food delivery, and we were in the home food delivery space. So we were able to cut our marketing costs, our sales tripled, and we had margins that private equity companies wanted. So we knew we were at the top of what our valuation would be. It was not the plan, but we sold that company to a private equity firm. And all of that studying, all of that research, I knew exactly what to do with the money when I got it. And it wasn't to put it anywhere in the traditional financial system. The key principle was I don't invest in derivatives. The closer I can get to the source of the returns, the bigger and better they will be. So for instance, if your financial advisor is telling you to buy a REIT, you're getting a derivative of a real estate product. If we do it private placement, now you're invested in the actual real estate. We're getting closer to the source. So that's what happened when we sold the company. Is I basically went on a countrywide mission, doing a ton of networking, spending a lot of money on high-end masterminds, because I knew proximity, what was going to get me closer to the real investments that are available out there. And unless you've got, 5, 10, 50, some of these places won't even talk to you unless you have 100 million. That's where the real returns are. So when I met Cody Kearns and he was launching this hedge fund, I was the first investor. I put my money in before it launched. He had a bunch of friends that were really well connected with this algorithm provider. They got $3 billion in there, which is not massive, but it's not small. 3 years of track record on this algo. Everything checks out, perfectly SEC compliant. All these things that, you look at, right? Third-party reporting, massive. Like, I know that every Ponzi scheme from Bernie Madoff to FTX, they all did internal reporting. That's how you get hurt. If the fund managers make a mistake and they don't want to tell you, they could falsify reports. There's all these things that can happen where people get hurt. So when Cody told me he was designing the fund from the beginning to avoid that, and he was putting the Boulder Group in place to do all of the compliance, to handle all the wires, to send all the monthly statements, it makes us accountable. It made me feel very, very safe in putting my money into this product, because it's usually not the investment that goes wrong in the private placement space. Of course it happens, but it's the people, it's the person you're getting behind that's the most important. And that's how we ended up launching this hedge fund. Started raising capital together, and we're approaching 20 million, and it hasn't even been a year yet. And we feel very, very confident that we're going to keep producing returns that beat the benchmark, and we'll continue to diversify it as the fund grows to make it safer and safer and safer.
I love that. So folks, I real quick just want to talk a little bit here about mine, just so I always put my money where my mouth is. I usually won't talk about something unless I already put my money in it and test it out. Many of you saw it was meant to be a joke, but the joke of a video that I did on the forklifts, right? Flipping forklifts. And it seems like every week I hear of somebody I know buying a forklift. They come up to me and they're proud and they're like, hey man, I got a forklift. And I'm actually kind of upset because this is not a big company. And I'm like, you bought a forklift, Joe bought a forklift, Steven bought 1, 2, or 3, Shauna bought a forklift. I don't even know who else. There's not going to be any more forklifts for me. I'm going to have to be the one waiting in line because I spread this good thing, but that's the giver's mentality. So it's okay. I'm joking about that, but I did it first because I wanted to see it work. And literally I remember me and Jordan were filming the video for it, and I'm just holding the check for the profit. And I'm like, this is insane. But you know what else is insane? Like I did this investment, 50 grand for my self-directed IRA, 50 grand for my infinite banking policy. Here's my statement, folks. I don't know if you can see this. Remember, he just mentioned Boulder. Can you see that? I don't know if it's blurry, but it says Boulder. This is my statement that I get. There's my address. I put 50 grand into this one. Remember, I got 100 total, but they report separately because each are different accounts. This 50 grand went in sometime in February. Let's call it mid-February. So what are we? We're May 24th today. This report is to the end of April. So mid-February to the end of April. Can anyone guess what my return's been for those couple months? Anyone? My year-to-date return? What do you think I've made on this so far? No one wants to guess? I'll just give it to you. There you go. Aaron got it right. 15.92%. My 50, and I don't know if you can see that, it's maybe blurry, but my 50 has grown to 57,961. But you know what? The best part about that is not so much that it's grown to 57,000. The best part is it hasn't gone down at all. So I'm not going to show you this whole thing because we're still working on this, but I'm too excited to not at least show you a little bit of this because I'm going to show you how I did mine. And I think you guys will really, really enjoy this. So this is a presentation I'm building that is going to be a case study that will be on BeYourOwnBank.com on how I've done this. So if you look at this, this is how I started it. So at first I put my money into my own private bank. As you all know, I mean, why would I put my money in somebody else's bank? This isn't the self-directed IRA one, but this is the one I did for my policy. So I put 100 grand the first year into this policy. It was mostly a dump in. And then each year, outside of the first year at 100, I'm putting $12,000 into it, okay? Because that's the policy design. So 100 with the dump in, and then $12,000 each year after that. So it's a small policy. It was just had a big dump in. And why I did this policy is I had money coming in from recycling and recapturing that I had just sitting in that segregated account, and I just wanted to reposition it. And then I just had, it wasn't a full 100. It was the dump in was the difference. When I put the 100 in, most of it was paid up additions. So therefore I had 94,000 in cash value the first year, or 94% of that money, primarily because of the way I built it. Not all policies are going to look that way. So the reason I have so much cash value in the first year is solely because the majority of that 100,000 was a dump in into the paid up additions. And remember, paid up additions are money that go into the general account of the insurance company. So you have access to most of it. Only 12,000 was my premium deposit. And of that 12,000, only 25% of that went to base. So that's the design. So what I'm going to do is I'm just going to kind of show you the cycle. The second year, I didn't do anything in the first year. The second year, I put another 12,000 in. So now my cash value is 105,799. And then I heard about this thing with Justin. And here are the returns. Now, this is old. This goes up through March, but this is what I was looking at when I saw it minus March. So I was looking at the comparison between the S&P and this hedge fund. And yes, some months like July last year, the S&P 500 beat the hedge fund. Hedge fund's in yellow, S&P is in red here. But then in August, you see this hedge fund made 3.88% and the S&P lost 4%. The next month, this hedge fund made 6.63, and that same month, the S&P lost. You see, the difference isn't so much that the returns are staggeringly different than the S&P 500. The difference is I have none of these drawdowns. Okay, I didn't lose 4, I didn't lose 9, I didn't lose 5, I didn't lose 2. I just made every year. So what I did here is an example. I'm going to do a little bit of hypothetical future pacing because we don't have a full year. Okay, but I can give you pretty close to the numbers. So I took that money in the third year and I took 100 grand out. Now remember, I had 119,000 by the third year. So I had put in 100 the first year, 12,000 second year, 12,000 third year, of which I had 119 total. I took 100,000 out and I put 100,000 into currents. Now, if I just looked at a year of 1 year return, that would basically be based on those returns I just showed you. If I just added the rest of them to get me to 1 year, which was only a couple months, so there's only a few months that aren't actual returns, that means that my 100 would have made $87,029. Now, I know that seems too good to be true, but listen, I just showed you almost the entire yearly cycle. And actually, Justin, if I'm not mistaken, let me back up here one, because what I showed here, there we go. this is up to March, but what was April? How much did April make?
4.61.
So 4.61. So the only months I don't have is May. How's May trending right now? Do you know?
Don't have official numbers,
Okay.
but it's in the positive. We can say that.
It's in the positive. So I got May, June, and July. Okay, we're almost at the end of May and we're in the positive. So that'll probably be okay. So June and July are the only months. Now, the other thing too that we didn't talk about is I know for a fact that this hedge fund has protection on the downside with stop losses. The algo has a stop loss built in so that any position they take, the most it can lose is 1.3%. Am I correct in saying that? 1.3?
Yep, that's the max drawdown.
Max drawdown. I can only lose 1.3. So I can't lose 9, I can't lose 4, I can't lose 5, I can't lose 2. I'm just trying to be transparent with you folks. I'm trying to show you like what I did. So that would be $87,029 that my 100,000 made. I'm almost there. You heard my numbers. If I did that, okay, if I made 87, what would I do? Well, that money would basically come into my segregated account after 12 months if I wanted. I could take all this money out. So after 12 months, which I'm showing here in the third year, I could take $187,029 out and put it into the segregated account. What do you think I would do then? Well, darn it, I would pay the policy loan interest. You guys weren't ready for that. You never steal from your bank. The insurance company on that $100,000 loan charges me interest. So what I'm going to do is out of this $87,000 that I just made, I'm going to give $5,200 of that back to the insurance company in loan interest. But didn't I already make interest on this? Yeah, for 3 years I've been compounding. And even when I took the 100 out, I still have 119,000 earning interest and dividends. So really paying the insurance company $5,240 doesn't mean anything to me because I'm going to make more than $5,240 just on my 119,000 earning interest and dividends. Now, I know I told you I took the policy loan interest out of the gains, but you see, I also made money on the policy. So indeed, I made money twice on the same money. And then once I do that, what I would do is in the fourth year, and this might not illustrate perfectly because this is where I got to change it. But in the fourth year, I put 12,000 in. My 12,000, okay, I have a net cash value of 13, a loan balance of 120. I have another 20 grand I could take out of the policy. So I would take the 20 grand out of the policy, so a loan. I would take the gains that I made the previous year plus the 100,000. I would just float that, and I would take the Kearns Capital gains plus the policy gains right here, the 20, and I would start lending that money out to someone on Private Money Club. And I would keep repeating that cycle. Now, pretty soon I'll have this full training ready for you guys to see. But for right now, that's as far as I've gotten with it. But I thought it was good enough to at least show all of you that, because it just gives you an idea of what we're talking about and what we're going to be teaching you on the 3-day in depth. You see, it's not just one thing. And a lot of people, when they look at the infinite banking concept and they look at these policies that we're always talking about, they think, oh, I'm going to put money in the policy, or should I put money in the S&P 500? Oh boy, should I put money in the policy, or should I put money in Kearns Capital? Or should I put money in the policy, or should I do, this private loan or this investment? You do both. You start by changing where your money goes first. All I do is I put my money through the policy first. I don't leave it in the policy. That's not what we teach. I put it in the policy. I look for an opportunity. I just so happened to be lucky that I was at the same mastermind that Justin was. I happened to be speaking. He said he ran a hedge fund. Instantly, being an ex-Wall Street guy, I'm like, oh, either I'm going to get along with this guy or me and this guy are going to be throwing punches after this thing's done, because it was going to go one of the two ways. And I picked on him the whole time during my talk, but we hit it off. And when he started telling me what he's doing and that, I knew about forex. And all of a sudden, after that day, I did my research. I reviewed and had my attorneys review the very long PPM, but it's good because it covers everything. The PPM is the private party memorandum. That's what you'll get if you want to invest in Kearns Capital, plus a subscription agreement. They're long. There's a lot of language there. You could have your attorney look at it like I did. Your attorney's going to send it back with some red lines asking weird questions that really don't mean anything. They're just justifying the hour that they spent and why they're charging you $250 or whatever your billable rate is. And then they're going to send it back. But there was nothing wrong. So I did it and I put the money in. I'm not saying you have to. This isn't a recommendation or suggestion. But listen, all I did is put my money to work. And that, what I just showed you, could be, it isn't yet, but very well could be the outcome of what that actually looks like in a 12-month time frame. So folks, if anyone's interested in learning more about that, Justin, do you want to give them the link? Do you want to pop that in the chat so they can set up a call with you to talk to you about that?
Yeah, I'm gonna throw the website on here, and it's exactly how it's coming through. It's just kearns.capital, and there's a little submission form on there. You can hit that. You could also go to my website and go directly through there. So I'll put that one in there as well. And this one will take you directly to my Calendly. So if you want to meet with me directly, go to toptierhuman.com, go to the Kearns Capital page and hit the Calendly there, and then we can dive into, if this is a good fit for you.
So there you have it, folks. Set up a call, talk to Justin, just like I did. If it's something you think that would be interesting for you to diversify into, I think it's a really good opportunity. It's a really good time for currencies. And we wanted to make sure that we brought that opportunity to you guys. So let me just hit a couple of questions about this. Do you need to be accredited? Yes, Paul. So you do have to be an accredited investor because it is, a fund that requires you to have, and do you want to define that? 200,000 in income with the anticipation of doing 200,000 or more in the future, or $1 million in assets excluding your home?
Yeah, depending on how you file your taxes. If you file your taxes joint married, you need 300,000 in gross income in the previous 2 years, with the expectation of having that again in this calendar year. If you're filing single, then it's 200. And then $1 million net worth, excluding your primary residence, is another way that you can become an accredited investor for what's called a 506C Reg D. That's the type of fund that we are.
That's funny. Sam said, if I invest in this, can I have a meeting with Justin at his place in Las Vegas?
Hey, investors are welcome anytime. Hang out by the pool and muck it up.
Very good. Very good. All right, folks. So we've covered real estate. We've covered the private hedge fund. We've covered a way that I did it through my policy, and you saw the benefits where I got to make money twice. So at this point, let's just go back real quick to what we've got going on this weekend. I just want to spend 2 seconds to make sure you all have the opportunity to get that limited edition shirt, which will either be a hoodie, or I guess we might even be able to give you the choice of what you want. Steven's working on that right now. But this is the link, okay? You come in here, you'll be able to see everything. It's going to be next week, Friday, Saturday, Sunday, the first week in June. And then we got so many testimonials. When Steven's computer comes back on, I'm sure we'll hit some of those. These are videos that we've done all about the event. So kind of mini videos about some of the topics you're going to learn about to give you an understanding of the depth that we're going to go into. At the virtual event, there's going to be lots of speakers. So here's just a few. Maybe you've heard Greg Herlein speak about self-directed IRAs. You got Brent Carlson, always one of the most popular speakers about entity structure. They also do bookkeeping, corporate credit, and they have a CPA division, where they can do your taxes. So I get a lot of people asking about that. Matthew Sullivan from Quantum, Kevin Shortell about notes. Bitcoin's still a very popular thing people want to know about. So we got Spencer coming in. Noah Harris is coming in to talk about private lending. And then we got the 2 mics coming in. They're going to be talking real estate, a little bit more about what we just talked about, but the proper ways to do it. You'll get a lot more than what we went over today. And then you got Mr. Justin, who you just heard from, who will go into a little bit more about what the private hedge fund is, and who knows what he's going to talk about. So folks, like I said, today only, you can get into this 3-day event for $197. Okay, that's $100 off the ticket price. So what you're going to do is you're just going to go in, you're going to click reserve my seat. Down here, you're going to enter, here's some more testimonials. And then there's going to be a discount code, which my eyes must have went right over it. So you're going to enter a discount code, and that discount code right here, coupon. So you're going to go in, you're going to enter summer start. I'm going to put this all in the thing. You're going to enter summer start, apply the coupon. And what that's going to do is bring your price down to $197. Okay, that's the first part. But then after the $197, what you're going to do is you're going to right here tell us what size shirt, or if you want the hat, put limited edition hat. You can put whatever you want, just hat or hoodie. And then what we're going to do, we're going to have your email. We're going to email you over a link, and you're going to be able to pick what you want. Okay, so the equivalent of what you're going to be able to pick, we put a budget. It's up to $60. Okay, so anybody that signs up today only, this will not be available anywhere else. But you're going to have the ability to get this Make Banking Great Again item, hat, hoodie. I don't know, there'll probably be other things. You just got to tell us what size you are here, and then you're going to get that. So I'll put that in the chat right now so anyone can take advantage of it. I don't want to keep talking about it, but that's what we put together. I apologize, we don't have the pictures of what the items are going to look like, but it's going to be badass. And you literally will be the only one ever to have that specific item because this event is the only time you're going to be able to get it. We're going to be doing it each preview event. We'll have a different offering like that, but that's the only way you can get it. So Justin, what do you think we should go into now? There's so many other fun things. I talk about private lending all the time. So I'm kind of, I want to put that one on the table for the 3-day. But what other things are you doing out there with money?
I think getting what we talked about a little bit earlier, the tax stuff.
Why don't we hit a little bit of that? How many of you want to talk tax stuff real quick? Tax planning, IRAs. Okay, so let's do this because it all kind of falls into it. Everybody wants to hear about taxes. Let's talk a little bit about how you mitigate paying taxes legally.
Love it. So first of all, I'm not a CPA or anything like that. So I'm just going to tell you what I've been doing working with my team. So the first thing is just understanding the two sides of the equation. You've got your active income and then passive income, and that's how taxes flow. So active income can only use active write-offs. Same thing with passive income. It only can use passive write-offs. At least that's what I've been told. On the passive side of the equation, that's mostly what we're talking about today, right? If you make an investment in the partnership at Kearns Capital, you're going to get passive income. So in terms of tax planning with that, we need to find ways to get passive deductions. So for me, I started with real estate first. I started taking profits from our food company and investing in these big multifamily projects. And I didn't really understand the power of the tax side of it. I was doing it because I was more interested in the return of capital. I could get 4 to 12% cash flow in a value add deal. And then at year 3 and 4, when they're done raising the NOI, there's a refinance, I get my money back, and now my equity's still in the deal. And then it's an infinite return. That was very exciting to me. I discounted the benefit of the tax losses that come from cost segregation, depreciation, CapEx spent on the projects. And I ended up with over $200,000 of passive losses that I could not use. So that's what led me to looking for other ways to create passive income, because now I figured out a vehicle where I can basically get all my passive income without paying taxes. And that's where Kearns Capital really came in, because the returns were outsized, beating the market. And we're doing high frequency trading. So it's not the kind of thing where you can hold the investment for a year and it turns into capital gains. You're going to be taxed at the highest bracket. So tax mitigation, very important with our hedge fund. And to this day, I have still not paid $1 in taxes on my passive hedge fund income because of all the real estate I bought. So now what I look at every year is what's my taxable liability. And at the end of Q3, I'll probably take a distribution from the fund or use cash from elsewhere to go make a real estate investment in Q4 to get rid of whatever that taxable liability is. And if you're in the right project, the right deal, which I'm very well connected, there's always 5+ deals to invest in as an LP. You can get 60 to 80% of your initial investment as a tax write-off in year 1. It's got to be a development deal or value add deal usually to get that type of appreciation on the K1. But it's very compelling. If you can put, if I was going to invest $200,000, I'd have 100 in Kearns Capital, making 50, 60. Historically, that's what it did. Can't say it's going to do that moving forward. And then I'd take the other 100,000 and dump it in a real estate deal. Now I've got about 50% net return and I didn't pay any taxes at all. Now on the active side of it, it's a little different. I just found an oil and gas company that allows you to invest as a GP, which makes it active, the write-off. So that's something I'm looking at now to how do I start mitigating my active income taxes as well.
Love it. So that right there. So we got active income, you need active withdrawals, passive income, passive withdrawals. Justin just said a few things he does. Now, I do things a little different. So I have no desire right now. So I'm kind of the other side of what Justin's doing. I've looked at so many oil investments, GP and LPs, and every time I send the PPMs over, or the investment agreements over to my attorneys, they're like, they find a million ways to punch holes in it. One that recently I dove deep in because I was really interested in investing in it for tax reasons, but also because it seemed like a good investment. I couldn't get my attorney to just get past the fact that there was really an unlimited risk in it. And you just got to really, the reason I'm bringing this up is not to scare all of you away from any type of an oil investment, either as an LP or a GP, but just to get you to start doing your due diligence. So every investment I look at, Kearns Capital to be included, I have legal on retainer. Now, I know not everybody does. I'm fortunate to have that, but I review all of that. Now, coming to Private Money Club very soon, you're going to be able to retain, however you need it, an investment advisor, okay, that will then review all of these types of documents. So you could retain an investment advisor for 30 days. There's like different packages on Private Money Club. There will be, I should say, from as low as $97 a month to as much as $500 or actually $1,000 a month is the top package. And you can do whatever you want with that during that period of time. So I use an attorney, which you can, but attorneys, just so you all know, they bill about $250 an hour. So I think some of you might be better off just paying $97 for a small retainer with an IA, and that would get you to that. So the reason I bring that up is when you get into this private sector, okay, into these unique investments, whether it's Kearns or syndications or oil investments, you're going to have a little sophistication in reading the documents and understanding the risk versus the reward and whether or not it fits you. Now, some of you might be like, I have no idea what I'm reading here. Totally understand that. I come from the Wall Street world, so I have a little bit higher level of knowledge of that. But if you don't, just make sure you've got somebody else to review it. If you have your financial advisor review it, just know, because they're not selling it to you, they're going to poo-poo all over it, I guarantee, and they're going to try to scare you out of it. And many times that is what will happen. So that's why I have an attorney review it, or I would hire an investment advisor for that specific task, so that they're not getting their own, desires of managing money mixed with what I'm actually looking for them to do, which is give me true fiduciary investment advice. There is a difference. I hate to say that, but just sometimes know your financial advisor does not want to lose assets. And even if the assets aren't under their management, they don't even want you doing anything else with any of your money because they want it all. How do I know? Same reason Stephen knows. When we were advisors, that's what we were trained to do. Get it all. Don't give any of it up. That Justin guy, he gets none of it. We manage it all. And if we can't manage it, we tell them that's not smart. That's not a good investment. That's why sometimes you just got to be smarter than them and understand it's about you, not anyone else. You need to be a good steward of your money. And that's just some personal advice. But let me go one step further into taxes. So now Justin does it with, investments in syndications and oil. I do it a little different, and a lot of the people on my team do it a little different. Now, I want to preface, again, just like Justin said, I'm not a CPA. This isn't tax advice. I'm not making any legal recommendations. Get your own CPA, get your own attorney, have them review this. Meet with JP or meet with Solomon, whoever you want. I go through Solomon at Wealth Builders Group to do this. JP will be on the 3-day. They're both good. Why do we have 2 people in this? So you folks have options. I love Solomon, but unless your federal income tax bill is $200,000, well, let's just say $150,000 or more, preferably $200,000 or more, just your federal IRS tax bill, then you're not working with Solomon, because that's kind of where he's drawing the line. Where JP, who set all of his structure that I'm going to show you right now up with Solomon, but realized like, hey, there's a big need for people that aren't that far along and don't have $200,000 in federal income tax. So JP, the threshold is $400,000 in income per year. Big difference. $200,000 in federal income tax or $400,000 a year in income. Now, all of a sudden, that becomes a lot more available to some of you. So let me show you how this works. So before the trust structure, what I had is probably like a lot of you. I had a whole bunch of LLCs, okay? And some of these were S Corp, they were filed as an S Corp because I had employees, and some of them were just sole, and some of them were partnerships. So we don't really need to understand, but I had a bunch of LLCs with multiple partners. So I might have had a partner in this one. I might have had a partner in this one. This one's just me and my wife. This one might be a sole LLC, and this one's probably a partnership. And then I think I even had one C Corp in the mix. But anyway, there's too many to write. I had a whole bunch of LLCs. Now, what happened prior to what I'm doing now is all of these, because they're all LLCs with, I'm sorry, not this one. All of these LLCs are passive, or pass-through, I should say. So that meant everything that I made or lost. So maybe this one lost 50K. This one made 500K. This one made 100K. Okay, net profit. Depending on my ownership, all of that income, that net income, would flow through to me personally. Okay, so this is how I used to be set up. So this was fine when I had real estate, because just like Justin, I had a whole bunch of real estate. We were constantly buying in selling real estate, but I was able to depreciate, take losses. This flip loses 40 grand. Sometimes I wasn't even upset because it offset the income taxes here and it was a learning lesson. But this is what I used to do. This model really screwed me bad. Now here's why. Because I got to a point where I started selling all these properties. I already told you. I started selling all these properties and that meant I had big profits. But it wasn't so much the profits. What it was is years and years and years of depreciation that I took on all those properties. So remember, every year I was using those properties, I was depreciating the rental fleet, and I wasn't paying much in taxes. Well, I was paying taxes, but not a ton. Then I sell them all. I profit on most of them, but also the IRS comes to me and they say, hey, we want some of that depreciation back. I'm like, whoa, didn't see that one coming. My CPA didn't tell me you guys are going to ask for the depreciation back. Sort of messed my numbers up a little bit. How much? Well, that year was like a $264,000 just IRS bill. I'm not going to get into the state bill. I live in New York State. I'm not even going to say it. But yeah, that's what I got. So all of a sudden now what I did is I started thinking really seriously about, okay, is this model the right model? And it was not. So now let me show you what you're going to learn at the 3-day. I'm going to hit it very high level, but at the 3-day, we're going to knock this thing out of the park. And for anybody that this is appropriate for, maybe some of the things I'm saying make sense. For some of you, you're probably, some of you are already getting off because you're like, this doesn't fit me. But for some of you, you're still watching because you're like, I fit that boat. How do I do it? So what they first did is they went through all my entities and they restructured them. Me and Larissa, however you want to do it, we only own 1%. Okay, so Chris now owns 1% of all of these entities. Who owns the other 99% or whatever percentage of that entity I own? A company that I also created called an operating company. Mine is called LC Holdings. Okay, this is my operating company. So now when the taxes flow through, 99% of them flow through to this operating company. Now, let's just say I need income because I got to live. Where do I take an income? Well, I don't take an income from any of these companies anymore. These companies all feed into this operating company of which I then derive an income. And you know the cool thing about this income? If any of you have ever seen a guitar amp or maybe the radio at your house, it's got this little thing. It looks like this. Sometimes it has a V on it. Do you know what that is? Volume. So if you're having a feisty day and you want to crank it up, you turn it up. And if you're not feeling so good and you want nice mellow music, you turn it down. Because of this right here, I get to have a volume. I can turn my income up or I can turn my income down, depending on how much money I need to live. So when inflation's running hot and groceries are more, I got to turn the volume up a little. But here's the cool part. My income, unlike a lot of yours and unlike my income used to be, is now at my discretion. I'm in 100% control. If I want to take $40,000 a year in income, some of you might be like, wow, that's crazy. Not really when you hear how the rest of it works. I don't think I could do it on 40, but I think I could probably get this down to $120,000 a year. Now, I'm not going to tell you what I make, but just you got to add some zeros. Okay. So it's in the millions. I don't want to pay tax on millions of dollars. I'd prefer to pay tax on $120,000. And as long as my wife and I can live on $120,000, that's all the income I will pay tax on. This is called 1040 tax return. This is how all of you file your taxes. You file it and right at the top it says 1040. But then what I learned about is this thing that all the wealthy families do called 1041 tax reporting. Now, here's what happens. So let's just say 2,500,000 comes over into this operating account, of which I take 120 and I'm going to pay tax on all 120. Now, what happens is I move some or all that money over here to what's called a business trust. And this is set up. This is not a statutory trust. It is a federal trust. It's very important, and you'll learn about that. So all that money. So here, can I just change these for simple math? Let's just make this 100,000. So now I've got $2.4 million that moved to the business trust. So what can the business trust do with $2.4 million? I can invest in Currents Capital with my business trust. I can lend money on PMC. I can buy stocks. I can buy real estate. I can buy rentals. I can buy syndications. I can buy gold. Are you getting the drift? I can do anything I want. I can invest in your company as a partner. I can do anything that I would have done up here, right here. but it is in a business trust, irrevocable business trust. Now, here's the downside. Now, I want to scare all of you. Once you begin this process, you no longer have access to take money out of the trust once it goes in. So once that 2.4 million goes into the business trust, I no longer can take it out. It is irrevocable. And some of you are like, oh, no way. Let me repeat something. You need to learn how to own nothing and control everything. I control everything here, and I only own 1%. So if somebody sued me for anything, I am 1% liable. That's it. That is it. 1%. Everything else that I invest in goes through my business trust, which you can't get because it's irrevocable. But you see, it doesn't stop there. Whatever I don't decide to spend in the business trust, what I'm going to then do is I'm going to move it over here to the family trust. And what does the family trust own? My house. Okay. So my primary residence, and we have a nice house, is in this family trust. So who do you think pays for my house? It's not me out of this 100,000. It's out of whatever I didn't spend from the business trust here. So let's just say I spend 400,000. So I move, it wouldn't be that much. Let's say I move $1 million of the 2.4 over here to the family trust. Now that $1 million pays for my house, maintenance of my house, taxes of my house, pays for Vivi's private schooling, pays for anything that would have to do with my family. Okay, so let's just say out of that, I spend 500,000 there. Now I want to be very clear. Up to this point, the only tax I've had to pay is $100,000 because everything else has gone through this complex trust structure. But now here, there's still $500,000 left. Final step. This is the ultimate, folks. This is the most important thing. I love to give. There's nothing more that makes me warm and warms me up inside than giving. Like when I'm at a gas station right around the corner here, and a guy walks across the street carrying a bag full of cans. He's super skinny. It's a cold day. You can see he's probably freezing. He looks a little dirty, and he walks over to the garbage cans, takes the top off, and starts taking cans out. I stop pumping gas. I walk up to the man, and I hand him whatever money's in my pocket, okay? That right there makes me feel better than anything I could ever buy. It makes me feel better than buying a Ferrari, a Porsche, not that I would, but there's nothing greater than giving and how it makes you feel. So because I love to give, it would only make sense that the final step in this equation for tax planning and protection is a private foundation. So my private foundation, I love kitty cats, no surprise. We donate a lot of money to different foundations and different charities that help cats. One here is 10 Lives Club, just in New York City on a foundation trip. So me and my wife and my daughter took a vacation to New York City where we celebrated Vivi's 3rd birthday. Me and my wife, during one of the dinners, had a foundation meeting to decide what we wanted to lend or what we wanted to give, what charity we wanted to give to. We had done some research about charities in New York City, and lo and behold, we found out that Howard Stern's wife runs a really great animal charity, where 100% of the proceeds that are given to this foundation and this charity go to protect the animals. And she loves kitty cats. So naturally, that was our choice. So we decided while we were in New York to donate and make a pretty decent sized donation to that foundation. So now the 500,000 comes down here to the foundation. I am required to donate no less than 5%. So whatever I don't use, what can I do with the foundation? Does anyone remember back some time ago, it was all over the news, Warren Buffett made a public announcement that he was going to give his entire fortune to charity. Anyone remember that? He was going to give all of his money to a charity. And what charity was it? Well, it was the Gates Foundation. When he makes that donation to that foundation or that charity, that is a 100% tax write-off. Okay, we understand that. So when this money goes into the foundation, that's a write-off. I no longer have to pay tax on any of that 500,000. And I just got to give 5%. So Warren gave all of his money to the Gates Foundation. Bill and Warren are buddies. And Bill, owning the foundation, has the sole right and obligation to invest the foundation's money for growth into the future. What's a good investment? Well, Gates thought about it and met with an investment manager by the name of Warren Buffett, and they decided, well, you know what? A great investment for the foundation would be Berkshire Hathaway A shares. Bill Gates took that entire fortune that Warren Buffett just gave and got a tax write-off on and invested that in this little known company called Berkshire Hathaway, owned and operated and controlled by who? Warren Buffett. you got a 100% tax write-off. So even though when the money went into this trust here, I lost what you would call the ability to take it out, but I still control it all the way through. I can even take the money from the foundation, loan it back up to the operating company, have the operating company pay interest to the foundation. I can do whatever I want. I just can't take the money out, and it's all got to be within the rules, and that's what they do for me. So folks, this is what I do. Now, I know this isn't appropriate for everybody. It might be appropriate for 1 or maybe 5% of this audience. You will learn all about this at the 3-day training. This is how I do it. This is how Brent does it. This is how Joseph does it. This is how Mr. Burr does it. We all learn from the same person. Who? Brent Kessler. You're going to be able to do this if you want. So there's 2 different ways you can do it. You can do it the way that Justin's doing it. You can do it the way that, all of us are doing it, or you can keep doing it the way you're doing it if it's working. Choice is yours. We're just giving you options. All this stuff you can learn about on the 3-day training next weekend. And right now, in the final minutes, you can sign up, you can get your $100 off, and you can also get the limited edition shirt that is Make Banking Great Again. I urge all of you to set up a call with Justin with the link. Justin, can you put the links up just one more time here? And then for some of you, we didn't get your questions, but that's fine because we're going to be having the Ask Me Anything happy hour at 4:30. You guys can all join us there. And that is in a few short hours from now. And all of us will be on. So if you have questions about Kearns or anything Justin's doing, anything Steven's doing, or anything the entire team's doing, we'll all be on there. And then tonight, 3 hours of money multiplier in the infinite banking concept. So make sure you register for that event. It is free and it starts at 6 o'clock. And there you go. TopTierHuman.com. Book a call with Mr. Justin from Kearns Capital. Steven, anything you want to say to close this out?
Yeah, you can see me at secondtierhuman.com. And other than that, I'll see you guys at 4:30 today.
Love it. Awesome. Well, Justin, thanks for your time. We'll see you in a couple hours. We'll see the rest of you at Ask Me Anything or at tonight's training. Have a blessed day. Thank you for your time.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.